In most commodity markets, investors rely on a simple rule of thumb. When prices rise, supply responds. When supply responds, markets rebalance. That institution is deeply ingrained, and most of the time it works. Uranium is different. Despite rising prices and growing concern about supply, new uranium production does not appear when investors expect it to. Supply relief arrives late, unevenly, or not at all. And financial markets often move well ahead of the physical uranium market. In this video, I'm going to outline 4 structural reasons why uranium breaks conventional price logic. Together, they explain why higher prices do not bring supply forward, why scarcity persists longer than expected, and why uranium equities often reprice before the commodity itself. The first point is this: uranium supply is constrained by time, not price. In many commodities, price determines whether supply comes on. In uranium, price mainly determines whether a project is economic, not when production can begin. Uranium projects move through long, fixed sequences: permitting, licensing, financing, construction, commissioning, and ramp-up. These steps follow regulatory and physical processes that do not accelerate meaningfully when prices rise. Even mine restarts are not switches. They require capital, rehiring, refurbishment, regulatory approvals, and time. In many cases, that time is measured in years. Higher prices may justify development, but they do not compress the timeline. As a result, supply decisions made today affect the market well into the future, not in the near term. Point number 2 refers to the operating base, which cannot surge production without damaging itself. A common assumption is that higher prices will cause existing uranium producers to increase output. In practice, that flexibility is extremely limited. Uranium mines operate within narrow technical and chemical boundaries. In situ recovery operations depend on groundwater chemistry and permeability that degrade if pushed too hard. Hard rock mines face grade variability, water management, radiation control, and mill throughput limits. Producers optimize for stability and recoverability, not maximum annual output. Pushing production aggressively can reduce total recoverable pounds over the life of the mine. This creates a structural restraint. Even in a higher price environment, producers are disincentivized from chasing short-term volume increases. Very little usable spare capacity exists. Higher prices do not unlock hidden supply. They expose how constrained the system already is. The third point is this: new uranium supply arrives after price discovery, not before. Uranium prices are formed primarily through long-term contracting, not spot transactions. Utilities secure fuel years in advance based on expectations about future availability, not current price levels. When utilities become concerned about future supply, they contract earlier, contract longer, and accept higher prices to secure delivery certainty. That behavior pushes prices higher before new supply can realistically respond. By the time development projects react to those price signals, the contracting cycle that drove the repricing has already occurred. Supply response, when it finally arrives, comes into a market that is already adjusted. This reverses conventional commodity sequencing. In uranium, price rises first to ration limited near-term supply. Supply response follows later, if at all. This is why uranium equities often re-rate before physical shortages are visible. The final point is this: price reallocates scarcity. It does not eliminate it. When uranium prices rise, the system adapts through behavior rather than through rapid increases in output. Utilities adjust contracting strategies. Inventories are drawn down. Competition intensifies for dependable pounds. What price determines is who gets supply and on what terms. What price does not do is suddenly create more supply inside the window that matters for market balance. This is why uranium markets can appear calm for long periods and then reprice abruptly. The pressure builds quietly inside the contracting system. When recognition shifts, price moves quickly because the physical constraints were already in place. Waiting for visible shortages or dramatic spot price spikes often means reacting after the repricing has already begun. To bring this together, uranium breaks price logic for 4 interconnected reasons. Supply is governed by long timelines that price cannot compress. Existing mines cannot surge output without harming long-term recoverability. New supply arrives after price discovery, not in time to prevent it. And higher prices reallocate scarce pounds rather than resolving scarcity. For investors, the most important adjustment is this: don't expect price to fix the uranium supply problem on your timetable. Price responds to scarcity. Supply responds to physics, regulation, and time. That gap is where the market reprices.